Something is breaking beneath the surface of the American economy right now. The indicators that appeared before 1929, before 2008, they're all flashing again. But this time, there are three of them converging at once. In October 1929, families watched their life savings evaporate in 72 hours. In September 2008, 8.7 million Americans lost their jobs in 18 months. The people who saw it coming got out. The people who didn't paid with everything. But there's one signal that almost nobody is talking about. A pattern that has preceded every major financial collapse in modern history. And right now, that pattern is complete. Warren Buffett is sitting on $300 billion in cash. Jeff Bezos has sold $13 billion in Amazon stock. The CEO of JP Morgan just sold shares for the first time in his entire career. They're reading something, they see something, and they're not telling you what it is. This is not speculation. This is mathematics. This is history repeating itself with surgical precision. The question isn't whether it's coming. The question is, will you recognize it before it arrives? Empires don't collapse the way you think they do. There are no dramatic invasions. No foreign armies marching through the streets. No sudden moment where everyone looks around and says, this is the end. Instead, collapse begins quietly. It starts in spreadsheets and balance sheets. It starts with decisions made in wood-paneled offices by men who believe they're too smart to fail. It starts with a slow erosion of the foundations. So slow that by the time anyone notices the cracks, the building is already falling. This is the part they don't teach you in school. The Roman Empire didn't fall because barbarians were stronger. It fell because Rome debased its currency, overextended its military, and made promises it couldn't keep. The Spanish Empire didn't collapse because it ran out of gold. It collapsed because it had too much gold and didn't understand what that would do to its economy. The British Empire didn't end because of military defeat. It ended because 2 world wars drained its treasury and left it dependent on American loans it could never repay. Every empire follows the same script, and every empire believes it's different. They're never different. Over the past 500 years, economic historians have identified a pattern, a sequence of stages that repeats with disturbing precision every time a dominant economic power falls. Some call it the debt cycle, others call it imperial overreach, but whatever name you give it, the pattern is always the same. 7 stages, 7 steps from prosperity to collapse, and once you see it, you cannot unsee it. Stage 1, easy money and debt expansion. Every collapse begins with success. A nation rises to power through innovation, military strength, or geographic advantage. Wealth flows in, your confidence builds, and then comes the critical mistake, the belief that the good times will never end. Credit expands, lending standards loosen, money becomes cheap and abundant, governments borrow because they can, consumers borrow because everyone else is borrowing. Corporations borrow because debt is cheaper than equity. The entire economy becomes addicted to leverage. In Spain, it was silver from the New World flooding the economy. In Britain, it was the financial innovations of the City of London. In America, it was the Federal Reserve's printing press after 1971. The mechanism changes, the pattern doesn't. Stage 2. Asset bubble formation. When money is cheap, it has to go somewhere. And it always goes to the same place. Assets, stocks, real estate, commodities, anything that can be bought today and sold tomorrow for a higher price. Prices rise, then they rise faster. Then they rise so fast that the act of buying becomes disconnected from any rational assessment of value. People buy not because an asset is worth the price, but because they believe someone else will pay more tomorrow. This is the bubble. And bubbles have a distinctive feature. They feel like prosperity. Everyone is getting richer. Everyone is making money. The economy appears to be booming, but it's not real wealth. It's borrowed wealth. It's wealth that exists only on paper, only as long as prices keep rising, only as long as the music keeps playing. Stage 3. Wealth concentration. As the bubble inflates, something else happens. Something that seems unrelated, but is actually central to the collapse. Wealth concentrates at the top. The people closest to the money creation, bankers, financiers, asset owners, capture most of the gains. The people furthest from it, workers, savers, those on fixed incomes, fall behind. The gap between rich and poor widens into a chasm. This isn't a moral observation, it's a structural one. When wealth concentrates, consumption patterns shift. The middle class, the engine of sustainable economic growth, hollows out. The economy becomes dependent on asset prices rather than productive investment, and the political system becomes captured by those who benefit from the bubble's continuation. In 1929, the top 1% owned 40% of American wealth. In 2008, they owned 35%. Today, they own over 30%, and the top 10% controls nearly 70% of everything. The numbers change. The pattern doesn't. Stage 4. Currency debasement and inflation. Here's where governments make their fatal error. As the bubble grows and debt accumulates, they face a choice. Allow a painful correction or print more money to keep the system running. They always choose to print. Rome clipped its coins, reducing the silver content until the denarius was worthless. Spain imported so much silver that it destroyed its own domestic industries through inflation. Britain abandoned the gold standard in 1931. America abandoned it in 1971. Currency debasement feels like a solution. It makes debts easier to pay. It keeps asset prices elevated. But it doesn't solve anything. It simply transfers wealth from savers to debtors, from the prudent to the reckless, and it sets the stage for the next phase. Stage 5, loss of confidence. This is the stage that can last for years, or end in weeks. The system is fragile, but it continues functioning because people believe it will continue functioning. Confidence is the invisible thread holding everything together. Then the thread starts to fray. People begin to question the currency. They begin to question the government's ability to pay its debts. They begin to question whether the assets they own are really worth what the market says they're worth. This doubt spreads slowly at first. A few insiders move to cash. A few smart investors reduce their exposure. The warnings are there for anyone paying attention. But most people aren't paying attention. Most people are still confident because most people are always confident until the moment they're not. Stage 6. The trigger. Every collapse needs a trigger. Something that transforms doubt into panic. Something that breaks the spell. Here's what's crucial to understand. The trigger is never the cause. The trigger is simply the match that lights a fire that's been building for years. And the trigger is almost always something that experts dismiss as contained, or too small to matter. In 1929, it was margin calls on over-leveraged stock positions. In 2008, it was defaults on subprime mortgages that represented a tiny fraction of the overall market. In the USSR, it was a failed coup attempt in August 1991, an event that seemed manageable until it was end. The trigger doesn't cause the collapse. The trigger reveals that the collapse has already happened, that the system has been insolvent for years, held together by nothing but confidence and momentum. Stage 7. The cascade. Once the trigger fires, time compresses. What took a decade to build unwinds in weeks. Forced selling creates more forced selling. Margin calls create more margin calls. Confidence evaporates overnight. Liquidity vanishes. Assets that were worth millions become worthless because there's no one left to buy them. This is the moment when empires discover what they're really made of. And what they discover is that they were built on sand. The cascade is brutal, fast, and utterly indifferent to human suffering. It doesn't care about your retirement account. It doesn't care about your plans. It follows the mathematics of a system that was always going to fail and is now failing. Now here's what should terrify you. This pattern isn't theoretical. It's not a prediction. It's a historical fact that has repeated across centuries, across continents, across political systems. Spain followed it. Britain followed it. The Soviet Union followed it. And right now, in 2026, the United States has completed stage 5 and is waiting for stage 6. The trigger. The smart money knows this. The billionaires know this. The insiders know this. That's why they're selling. That's why they're converting to cash. That's why they're preparing for what comes next. The question is, do you know it? Because in the next sections, I'm going to show you exactly how this pattern destroyed the world as greatest economies and why the math says America is next. Let me take you back to a world that felt invincible. It's 1927. The United States has just won the Great War. American factories produce half the world's manufactured goods. The automobile has transformed daily life. Electricity lights up cities from coast to coast. Radio broadcasts bring entertainment into living rooms. And the stock market is making everyone rich. This was the roaring 20s. Jazz played in speakeasies. Flappers danced to Charleston. And ordinary Americans, plumbers, teachers, factory workers became convinced that they had discovered a perpetual money machine. Between 1923 and 1929, the Dow Jones Industrial Average rose from 100 to 381, a nearly four-fold increase in 6 years. Stocks didn't just go up, they went up every month, every week, seemingly every day. Financial magazines ran headlines about a new era in which the old rules of economics no longer applied, and everyone believed it, because why wouldn't they? The evidence was right there in their brokerage statements. But here's what they didn't see. Here's what almost no one saw. The crash didn't begin on Wall Street, it began 3 years earlier, 1,200 miles to the south, in the swamps of Florida. Picture Miami in 1925. Palm trees, ocean breezes, and the most spectacular real estate bubble in American history. Land speculation in Florida had gone completely insane. Developers were selling plots sight unseen to buyers in New York, Chicago, and Boston who had never set foot in the state. The scheme was elegant in its simplicity. You put 10% down on a piece of land, then flip it to the next speculator before your next payment was due. Everyone was making money. School teachers became real estate moguls, barbers gave stock tips between haircuts. The belief was unanimous. Florida land prices could only go up. Then, in September 1926, a Category 4 hurricane slammed into Miami. The storm killed over 400 people. But that wasn't what destroyed the bubble. What destroyed the bubble was what people discovered after the storm passed. They finally went to look at the land they had purchased, and they found that half of it was underwater. Not because of the hurricane, it was swamp. It had always been swamp. They had been buying worthless wetland at premium prices. Overnight, $1 billion in real estate value evaporated. That's $18 billion in today's money. Gone in weeks. But here's the part that matters. Nobody connected the dots. The newspapers called it a regional correction. Wall Street analysts said Florida was isolated, irrelevant to the broader economy. The national mood remained euphoric. Stock prices kept climbing. What they didn't understand, what they refused to understand, was that those Florida land deals had been financed by rural banks across the country. Small banks in Iowa, Nebraska, Kansas had lent money to speculators buying swampland in Miami. When the land became worthless, those banks started failing. By 1929, over 600 banks had already collapsed. 600. Before Black Tuesday, before the panic, before anyone on Wall Street admitted there was a problem. The foundation was already crumbling, but the party continued. Let me explain the mechanism that made 1929 not just a crash, but a catastrophe. It's called margin trading, and it works like this. In the 1920s, you could buy stocks by putting down just 10% of the purchase price. The other 90% was borrowed from your broker. This meant that with $1,000, you could control $10,000 worth of stock. When prices rose, the leverage was magical. A 10% gain in the stock became a 100% gain on your investment. People who had never owned securities became paper millionaires. But leverage works both ways. If the stock dropped just 10%, your entire investment was wiped out. And if it dropped further, you owed money to your broker. Money you didn't have. This was called a margin call. When prices fell, brokers demanded immediate payment. If you couldn't pay, they sold your stocks at whatever price they could get. That selling pushed prices lower, which triggered more margin calls, which forced more selling. It was a death spiral built into the very structure of the market. And by 1929, 90% of stock purchases were made on margin. The entire market was a house of cards balanced on a foundation of borrowed money. All it needed was a breeze. The smart money saw it coming. Joseph Kennedy, father of the future president, later told a famous story. In the summer of 1929, he was getting his shoes shined when the shoe shine boy started giving him stock tips. Kennedy went back to his office and sold everything. When shoe shine boys are giving stock tips, he reportedly said, it's time to get out. But Kennedy wasn't acting on superstition. He was acting on mathematics. He understood that when the least sophisticated investors are piling into a market, the smart money has already distributed its shares. He understood that the shoeshine boys' enthusiasm meant there was no one left to buy. Bernard Baruch, one of the most successful financiers of the era, made the same calculation. Throughout the summer of 1929, Baruch quietly liquidated his stock positions and converted to cash and gold. He paid close attention to the Federal Reserve's signals that interest rates would rise, making margin loans more expensive. While the public celebrated new highs, Baruch was preparing for the collapse he knew was coming. These men weren't prophets. They were simply paying attention. The signals were there for anyone willing to see them. Industrial production had started declining in the summer of 1929. Car sales were falling. Construction was slowing. The real economy was weakening while the stock market kept climbing. That gap between economic reality and market fantasy was the warning, but warnings only matter if people heed them. The crash began on Thursday, October 24th, 1929. They would later call it Black Thursday. That morning, New York's largest investment funds made a coordinated decision. They had seen enough. Time to exit. They began selling in massive blocks. Hundreds of thousands of shares hit the market simultaneously. Prices that had been stable for months began to slip, then slide, then plummet. By noon, panic had set in. The ticker machines that reported stock prices fell hopelessly behind by over an hour. Investors had no idea what their holdings were worth. They only knew that whatever the number was, it was getting smaller by the minute. The telephone system collapsed under the volume of calls. Brokers couldn't reach clients. Clients couldn't reach brokers. Orders piled up unexecuted while fortunes evaporated. That day they traded 13 million shares, 5 times the normal volume. It was a record that would stand for decades. But Thursday was just the beginning. Over the weekend, newspapers tried to calm the public. Bankers issued statements of confidence. The great financier J.P. Morgan organized a consortium to buy stocks and stabilize prices. It didn't matter. On Monday, October 28th, the market dropped another 13%. And then came Tuesday. Black Tuesday, October 29th, 1929. 16 million shares traded. The ticker fell 2.5 hours behind. Prices collapsed so fast that by the time orders were executed, stocks had already fallen further. The Dow Jones dropped 12% in a single day. In 1 week, the market lost $30 billion in value. That's more than the United States had spent on the entire First World War. But here's what most people don't understand about 1929. The crash itself lasted only a few days. The depression lasted a decade. The margin calls that started in October didn't stop. Investors who had borrowed to buy stocks now owed money they didn't have. They sold everything. Not just stocks, but homes, cars, businesses, anything to raise cash. That selling wave spread from Wall Street to Main Street. Consumer spending collapsed. Businesses that depended on that spending began to fail. Workers lost their jobs. Without income, they couldn't pay their mortgages. Banks that had lent money to homeowners and businesses started to fail. By 1933, nearly 10,000 banks had collapsed. 10,000. The banking system that Americans had trusted with their life savings simply ceased to exist. And here's the cruel irony. Most of those banks had nothing to do with the stock market. They were small-town banks in rural America that had made conservative loans to local businesses. They failed because the system failed. They failed because confidence failed. They failed because when panic spreads, it doesn't distinguish between the guilty and the innocent. Unemployment rose to 25%. 1 in 4 American workers had no job. In some cities it was worse. Toledo hit 80% unemployment. Cleveland wasn't far behind. Breadlines stretched for blocks. Families who had owned homes for generations lost everything to foreclosure. Children went hungry. Men who had worked their entire lives stood in line for charity soup, their dignity stripped away along with their savings. And it lasted. It didn't recover in months or even years. The stock market wouldn't return to its 1929 high until 1954. 25 years later, an entire generation had their economic lives destroyed. I want you to understand something about 1929, because it's the key to understanding what's coming. The crash was not caused by one event. The crash was not caused by Black Tuesday, or margin calls, or the Federal Reserve. The crash was caused by years of denial. Denial that the Florida real estate collapse mattered. Denial that 600 failing banks were a warning sign. Denial that an economy built on 90% borrowed money was unsustainable. Denial that the gap between stock prices and economic reality would ever close. Every expert, every banker, every politician had a reason why the system was safe. Every warning was explained away. Every signal was ignored until it wasn't. When the dam finally broke, it broke completely. All the denial in the world couldn't stop the mathematics of a system that had been insolvent for years. Now I want you to hold this story in your mind. Remember the leverage. Remember the denial. Remember the smart money exiting while the public celebrated. Because in the next section, I'm going to show you how it all happened again. 80 years later, with different instruments, different players, but the exact same pattern. And then I'm going to show you why 2026 is worse than both. You know this story, or at least you think you do. Lehman Brothers, Bear Stearns, too big to fail. Foreclosure signs on every block. You remember the headlines, the panic, the bailouts, but let me show you what you missed. Let me show you the frame that changes everything. Because the 2008 crash didn't start with subprime mortgages. It didn't start with Lehman Brothers or credit default swaps or any of the things that became household names after the collapse. It started in 2004, in a conference room in Washington, D.C., with a regulatory change so boring that almost no one noticed it. The Securities and Exchange Commission, the agency responsible for protecting investors and maintaining fair markets, quietly changed something called the net capital rule. Before 2004, investment banks were limited to leverage ratios of about 12 to 1. That meant for every dollar of actual capital they held, they could borrow and invest $12. After 2004, that limit was raised to 30 to 1, sometimes higher. Read that again. A bank could now gamble $30 for every $1 it actually possessed. This wasn't a secret. It was voted on publicly. The commissioners approved it unanimously. The banks had lobbied for it, arguing that they had sophisticated risk management systems that made the old limits unnecessary. And with that single rule change and that boring, technical, forgettable adjustment, the fuse was lit. Let me explain what happened next, because this is where the pattern becomes unmistakable. With their new leverage capacity, investment banks needed something to invest in. They needed assets, lots of assets, and they found them in the most unlikely place, the American dream of home ownership. Here's how the machine worked. Mortgage lenders, companies like Countrywide, New Century, and Washington Mutual, began offering loans to anyone with a pulse. No income verification, no down payment. Adjustable rates that started low and exploded higher after 2 years. These were called subprime mortgages, loans to people who, under any rational analysis, could not afford to repay them. But the lenders didn't care whether borrowers could repay. They weren't planning to hold these loans. They were planning to sell them. This is where Wall Street entered the picture. Investment banks bought thousands of these mortgages, bundled them together, and created new securities called collateralized debt obligations, CDOs. They took garbage loans made to people who couldn't pay and transformed them into investment products. Then came the magic trick. The banks paid rating agencies, Moody's, Standard & Poor's, Fitch, to evaluate these CDOs. And the rating agencies, whose revenue depended on keeping the banks happy, slapped AA ratings on products that were built entirely from subprime garbage. AA, the same rating given to US Treasury bonds, the safest rating in existence. Pension funds that were legally required to hold only safe investments looked at these AA ratings and bought billions in CDOs. Retirement accounts across America filled up with time bombs disguised as safe assets. And the banks? They collected fees at every step. Fees for originating the mortgages, fees for packaging them into CDOs, fees for selling them to investors. The worse the loans, the higher the fees. The system was designed to produce garbage and call it gold. Some people saw through it. Michael Burry was a hedge fund manager with a glass eye and a medical degree who spent his evenings reading mortgage bond prospectuses. Documents so boring that almost no one on Wall Street actually read them. What Burry found horrified him. The loans underlying these OALA-rated securities were insane. Adjustable rate mortgages given to strawberry pickers claiming $700,000 annual incomes. Interest-only loans to borrowers with credit scores in the 500s. Houses in California being purchased with no money down by people who couldn't afford the first payment. Burry did the math. When the adjustable rates reset, when the teaser rates expired, and the real payments kicked in, borrowers would default by the millions, the CDOs would collapse, the entire system would implode. But there was a problem. You couldn't short a mortgage. You couldn't bet against someone's home loan the way you could bet against a stock. So Burry went to the banks and asked them to create something new: credit default swaps on mortgage bonds. These were essentially insurance contracts. Burry would pay premiums every month. If the bonds defaulted, he would collect the full insured amount. The banks thought he was crazy. They took his money gladly, convinced the housing market could never crash. Burry wasn't alone. John Paulson, a hedge fund manager who had never traded mortgages, came to the same conclusion. He bought billions in credit default swaps. He was paying $15 million a month in premiums, bleeding money while the housing bubble continued to inflate. His investors thought he had lost his mind. Some pulled their money out. But Burry and Paulson understood something the market didn't. They understood that the question wasn't whether the bubble would burst, it was when. Goldman Sachs understood too, but Goldman played a different game. In 2006 and 2007, Goldman created a CDO called Abacus 2007 AC1. But this wasn't an ordinary CDO. This one was specifically designed to fail. Goldman let Paulson's hedge fund help select the mortgages that would go into Abacus, and Paulson deliberately chose the worst loans he could find. Loans most likely to default. Loans designed to explode. Then Goldman sold Abacus to its own clients, pension funds, banks, institutional investors, as a solid investment. They never told the buyers that the product had been designed by someone betting on its failure. When Abacus collapsed, Goldman's clients lost over $1 billion. Paulson made approximately the same amount. Goldman collected fees from both sides. This isn't conspiracy theory, it's documented fact. It came out in Senate hearings. Goldman eventually paid $550 million to settle fraud charges, a fraction of their profits. The system wasn't broken. The system was working exactly as designed. It was designed to transfer wealth from the uninformed to the informed, from the slow to the fast, from Main Street to Wall Street. By 2007, the cracks were visible, if you knew where to look. Housing prices in the hottest markets had stopped rising. Mortgage defaults were ticking up. 2 hedge funds at Bear Stearns that had invested heavily in subprime CDOs collapsed completely, wiping out $1.6 billion. But the official response was calm, contained, reassuring. In March 2007, Federal Reserve Chairman Ben Bernanke testified before Congress. Fake. The impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained, he said. Contained. That word would haunt him. Treasury Secretary Henry Paulson, no relation to John, echoed the sentiment. The subprime problem was small, isolated, manageable. They were wrong. They were catastrophically, historically, unforgivably wrong. The collapse began in earnest in March 2008. Bear Stearns, the 5th largest investment bank in America, ran out of money in 72 hours. Not 72 days. 72 hours. On Monday, they had adequate liquidity. By Thursday, they were begging the Federal Reserve for an emergency loan. The Fed arranged a shotgun marriage. JP Morgan Chase bought Bear Stearns for $2 per share. The stock had traded at $172 just 14 months earlier. Employees who had their retirement savings in company stock, who had believed in the firm, trusted the firm, lost nearly everything. But Bear Stearns was just the appetizer. On September 15, 2008, Lehman Brothers filed for bankruptcy. With $639 billion in assets, it was the largest bankruptcy in American history. It remains the largest to this day. This time, there was no rescue. No shotgun marriage, no Fed intervention. Treasury Secretary Paulson, whether through ideology or miscalculation, let Lehman fail. The next day, the global financial system froze. Banks stopped lending to each other. They didn't know which institutions were solvent and which were hiding billions in toxic assets. Trust, the invisible infrastructure of modern finance, evaporated overnight. Money market funds, where ordinary Americans kept their savings believing they were as safe as cash, broke the buck. The Reserve Primary Fund, one of the oldest and most respected money market funds, announced that its shares were worth less than $1. Investors panicked. $400 billion fled money market funds in 2 weeks. AIG, the world's largest insurance company, revealed that it had written hundreds of billions in credit default swaps, insurance on mortgage bonds, and couldn't pay the claims. AIG was days from collapse when the Fed stepped in with an $85 billion bailout, then $67 billion more, then $40 billion more. The final cost of saving AIG exceeded $180 billion. In the span of 2 weeks in September 2008, the entire American financial system came within hours of complete collapse. I want you to understand what complete collapse means. It means ATMs stop working. It means credit cards are declined. Not because you're over your limit, but because the system that processes transactions has frozen. It means businesses can't make payroll because they can't access their accounts. It means the supply chains that deliver food to grocery stores break down. Treasury Secretary Paulson later admitted that he contemplated this scenario. He and Bernanke went to Congress and warned of consequences almost too dire to imagine. They secured $700 billion in emergency bailout funds. The Troubled Asset Relief Program, TARP, the banks were saved, Wall Street was rescued, but Main Street was not. Over the next 2 years, 8.7 million Americans lost their jobs. Unemployment peaked at 10%, but real unemployment, including discouraged workers and those forced into part-time jobs, exceeded 17%. Household wealth declined by $19.2 trillion. Retirement accounts lost 40% of their value. Housing prices fell 30% on average, more in the hardest hit markets. Roughly 3.8 million foreclosure filings occurred in 2010 alone. Families who had done everything right, made their payments, played by the rules, lost their homes because they lost their jobs in a crisis they didn't create. Here's what I need you to remember about 2008. The trigger was subprime mortgages. But subprime mortgages were only 14% of the total mortgage market. A small slice, a contained problem. The crash happened because the small slice was connected to everything else. The leverage in the system meant that a small loss became a catastrophic loss. The interconnection between institutions meant that one failure triggered dozens of others. And the experts, the regulators, the Fed chairman, the Treasury secretaries, didn't see it coming. They didn't see it coming because they didn't want to see it coming. They were invested, financially and psychologically, in the system continuing. The trigger is never the cause. The trigger is never what experts are watching. The trigger is always something too small to matter. Until overnight, it's the only thing that matters. Now hold this story next to 1929. See the pattern. Leverage that transforms small losses into catastrophic losses. Check. A bubble built on borrowed money and denial? Check. Smart money exiting while officials assured the public everything was fine? Check. A trigger that seemed contained until it wasn't? Check. 2008 was 1929 with different instruments. The melody changed, the song remained the same, and now I need to show you why 2026 is different. Why it's worse. Why the bubble we're living in today dwarfs both of its predecessors, and why the tools that saved us in 2008 no longer exist. Now I need to show you something that has never happened before in financial history. In 1929 there was one bubble, stocks. The speculation was concentrated in equities, fueled by margin lending. When it burst, only 10% of Americans were directly affected, the small minority who owned stocks. In 2008, there was one bubble: housing and mortgage credit. The speculation was concentrated in real estate and the financial instruments built on top of it. When it burst, the government still had the capacity to intervene. The Federal Reserve's balance sheet was under $1 trillion, the national debt was $10 trillion, there was room to maneuver. In 2026, there are 3 bubbles, and they're all inflated at the same time. The stock market, consumer and corporate debt, and government debt. 3 bubbles, 3-time bombs, all with their fuses burning simultaneously. This has never happened before. Not in 1929, not in 2008, not in the collapse of the British Empire or the fall of Rome. There is no historical precedent for what we're facing. Let me show you each one. Bubble 1. The stock market. Open your brokerage app. Look at the numbers. Everything is at all-time highs. Your retirement account has never looked better. The market has been climbing for over a decade, and every dip has been followed by a recovery. It feels like prosperity. It looks like wealth. But let me show you what's underneath. The Shiller PE ratio, also called the CAPE ratio, is one of the most reliable measures of stock market valuation. It compares stock prices to average earnings over the previous 10 years. Adjusted for inflation. It smooths out short-term fluctuations and gives you a picture of whether stocks are cheap or expensive relative to what companies actually earn. In 1929, just before the crash, the Shiller PE ratio peaked at 33. In 2000, before the dot-com collapse, it reached 44. Today it sits above 35. We are in the same valuation territory as the 2 worst market crashes in American history. The only time stocks have been more expensive relative to earnings was the dot-com bubble, and that bubble was concentrated in technology stocks. Today's overvaluation spans the entire market. But here's what makes 2026 different from previous bubbles. Look at the concentration. 7 companies: Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, and Tesla now make up approximately 30% of the entire S&P 500. 30% of America's benchmark index is concentrated in just 7 stocks. This has never happened before. Not even during the dot-com bubble was concentration this extreme. What does this mean? It means the entire market rises and falls based on the performance of 7 companies. It means your diversified index fund isn't really diversified. It means the retirement savings of 100 million Americans are dependent on the continued growth of a handful of technology giants that are already valued at levels that assume decades of perfect execution. And how did these companies get so large? How did their stock prices reach the stratosphere? Stock buybacks. Between 2010 and 2023, American corporations spent over $7 trillion buying back their own shares, not investing in factories, not raising wages, not developing new products, buying back stock. Here's how it works. A company borrows money at low interest rates. It uses that borrowed money to purchase its own shares on the open market. This reduces the number of shares outstanding, which mechanically increases earnings per share, even if actual profits haven't grown. The rising earnings per share pushes the stock price higher. Executives whose compensation is tied to stock performance get rich. The company is no more profitable than before. It hasn't created anything. It has simply used debt to engineer a rising stock price. Now those debts are coming due. Interest rates that were near 0 in 2020 are now above 4%. Refinancing that debt costs 3, 4, 5 times what it cost when the borrowing happened. The financial engineering that drove stock prices higher is now a weight dragging companies down. And here's the darkest part. Retail investors, ordinary Americans, are more exposed to the stock market than at any point in history. Stock ownership as a percentage of household financial assets has never been higher. The generation that watched their parents lose everything in 2008 was told to buy index funds and hold forever. They did. They're all in. When this bubble bursts, it won't just hit the wealthy. It will hit everyone with a 401k, an IRA, a pension. It will hit teachers and nurses and firefighters whose retirement funds are invested in the same overvalued stocks. Bubble 2, the debt supercycle. Now let me show you the second bubble. This one is hiding in plain sight, in the wallets and bank statements of every American household. total household debt in the United States now exceeds $17 trillion. Let me break that down. Mortgage debt, $12.5 trillion. Americans owe more on their homes than ever before in history, even after adjusting for inflation. Auto loans, $1.6 trillion. The average new car payment now exceeds $700 per month. To make that number palatable, lenders have stretched loan terms to 72 months, 84 months, 7 years to pay off a depreciating asset. This is not a sign of prosperity. It's a sign that people cannot afford the things they're buying. Credit card debt, over $1.1 trillion, with average interest rates exceeding 21%. 1 in 5 Americans carries a balance from month to month, paying interest rates that would have been considered loan sharking a generation ago. Student loan debt, $1.77 trillion. An entire generation entered adulthood carrying mortgage-sized debts for degrees that often don't lead to jobs capable of repaying them. And here's the number that doesn't get reported. Total consumer debt payments as a percentage of income have been climbing steadily. For the bottom 50% of earners, debt service now consumes a larger share of income than at any point since 2008. The average American family is drowning. They're maintaining their lifestyle through borrowing. When the recession comes, when job losses mount and income falls, they will have no cushion, no savings, no margin for error. But household debt is only half the story. Corporate debt has exploded even more dramatically. American corporations now owe over $10 trillion. That number has quintupled since 2008. Let me say that again. Corporate debt has increased fivefold in less than 2 decades. And it's not good debt. It's not debt used to build factories or fund research. It's debt used to buy back stock, pay dividends, and fund acquisitions at inflated prices. The term you need to know is zombie companies. These are corporations that don't earn enough profit to cover their interest payments. They survive only by borrowing more, rolling over old debt into new debt, staying one step ahead of insolvency. How many zombie companies exist in America today? Estimates range from 10% to 20% of all publicly traded corporations. 1 in 5 companies cannot cover their interest expenses from operating profits. When interest rates were zero, this worked. Zombies could borrow indefinitely, but interest rates are no longer zero. The era of free money is over, and every zombie company now faces a choice: find a way to become profitable or default on its debt. The defaults are coming. They're already beginning. When they accelerate, they will cascade through the financial system exactly as mortgage defaults did in 2008. Bubble 3. Government debt, the one that didn't exist before now. Let me show you the bubble that changes everything. The bubble that makes 2026 fundamentally different from 1929 or 2008. The United States national debt now exceeds $36 trillion, and in 1929, federal debt was approximately 16% of GDP. The government had ample capacity to borrow and spend. In 2008, federal debt was approximately 64% of GDP. The government borrowed $700 billion for TARP, expanded the Fed's balance sheet by trillions, and ran massive deficits to stimulate the economy. There was room to maneuver. In 2026, federal debt exceeds 120% of GDP and is growing at $1 trillion every 100 days. This is the part that most Americans don't understand. We are running $2 trillion annual deficits in what the government calls a good economy. Not a recession, not a war, not an emergency. Just the normal operation of the federal government now requires borrowing $2 trillion every year. And here's the number that should terrify you. Interest payments on the national debt now exceed $1 trillion per year. The government pays more to service its past borrowing than it spends on defense, more than it spends on Medicare, more than it spends on everything except Social Security. Every dollar spent on interest is a dollar that cannot be spent on stimulus when the recession comes. Every dollar spent on interest is a dollar borrowed from foreign creditors who may not always be willing to lend. In 1929, when the crash came, the government could spend. In 2008, when the system froze, the government could borrow. In 2026, what can the government do? If it cuts spending to reduce the deficit, it will deepen the recession. If it borrows more to stimulate the economy, it will push interest payments even higher. potentially triggering a debt crisis. If it prints money to monetize the debt, it will ignite inflation that destroys the currency. There are no good options. The government has spent the last 2 decades using future resources to paper over present problems. Now the future has arrived and the resources are gone. I need you to understand why the convergence of these 3 bubbles is unprecedented. In 1929, only stocks were in a bubble. The government was solvent. Consumer debt was low. When stocks crashed, the damage was contained to those who owned stocks. In 2008, only housing and credit were in a bubble. The government had borrowing capacity. The Fed had room to expand its balance sheet. When the system froze, there were tools available. In 2026, everything is in a bubble simultaneously. Stocks are at valuations that have preceded crashes 100% of the time in history. Consumer and corporate debt are at levels that guarantee widespread defaults in any recession. Government debt is so high that the traditional tools of stimulus and bailout may not be available. And these bubbles are connected. When stocks fall, household wealth falls. When household wealth falls, consumer spending falls. When consumer spending falls, corporate revenues fall. When corporate revenues fall, corporate defaults rise. When corporate defaults rise, banks take losses. When banks take losses, lending freezes. When lending freezes, the economy contracts further. And through all of this, the government will be trying to service $36 trillion in debt, while tax revenues collapse and demands for unemployment benefits and social services explode. This is not a recession we're facing. This is a systemic crisis with no obvious exit. Let me leave you with a comparison that crystallizes the danger. Japan's stock market bubble burst in 1990. The Japanese economy entered what economists call a lost decade. But it wasn't just 1 decade, it was 3 decades. The Nikkei did not return to its 1989 high until 2024. 34 years later, an entire generation of Japanese citizens never recovered the wealth they lost. They retired poorer than their parents. They watched their children struggle in an economy that never truly healed. And Japan had advantages America doesn't have. A high savings rate, a trade surplus, a homogeneous society with high social trust, creditors who were mostly domestic. America has none of those advantages. We have a negative savings rate, a massive trade deficit, a deeply divided society, and creditors, especially China, who may not be willing to keep lending when the crisis hits. If America follows Japan's path, recovery could take decades. But if the crisis is worse, if all 3 bubbles burst simultaneously, recovery might not come at all, not in any form we would recognize. The question is no longer whether the bubbles will burst. The question is what will remain when they do. Let me tell you what the billionaires are doing right now. Not what they're saying, what they're doing. Because in finance, words are cheap. Press releases are theater. CNBC interviews are entertainment. But money, the actual movement of money, tells you everything you need to know. And right now, the money is moving, quietly, systematically, out of the market and into safety. Warren Buffett has spent 70 years building a reputation as the greatest investor in history. His company, Berkshire Hathaway, has outperformed the S&P 500 across 6 decades. When Buffett speaks, markets move. When Buffett acts, smart investors pay attention. So what is Buffett doing? In 2024 and into 2025, Berkshire Hathaway sold over $130 billion in stocks. Apple, Buffett's largest and most celebrated holding, was cut by more than half. Bank of America shares were liquidated by the billions. And what did Buffett buy with the proceeds? Nothing. Berkshire Hathaway now holds over $300 billion in cash and treasury bills. $300 billion, the largest cash position in the company's history, larger than the GDP of most countries. At the 2024 shareholder meeting, Buffett was asked about this unprecedented cash hoard. His answer was carefully worded but unmistakable. He said he doesn't mind paying taxes on gains, implying he expects tax rates to rise. He said cash isn't all that bad, implying stocks might be worse. He said he's waiting for opportunities, implying current prices don't qualify. This is Buffett speak. Decoded, it means I'm getting out. The market is overvalued. Something is coming. But Buffett isn't alone. He isn't even the most aggressive seller. Jeff Bezos, founder of Amazon, one of the richest humans in history, has sold over $13 billion in Amazon stock since 2024. Not transferred to a foundation, sold, converted to cash. Bezos built Amazon from a garage bookstore into a $2 trillion company. He knows the business better than any analyst, any fund manager, anyone. If he believed Amazon stock was undervalued or even fairly valued, he would be buying, not selling. He's selling. Mark Zuckerberg has sold billions in Meta shares. The stock has been hitting all-time highs. The AI narrative has pushed technology valuations into the stratosphere, and the founder, the man who controls the company absolutely, is cashing out. Jamie Dimon, CEO of JP Morgan Chase, sold stock in 2024 for the first time in his 18-year tenure running the bank. The first time ever. Dimon has been through the dot-com crash, the 2008 crisis, COVID. He held through all of it and now he's selling. When asked why, Dimon gave a non-answer about financial planning. But Dimon doesn't need financial planning. He's worth over $1 billion. You don't sell for estate planning purposes when you're still running the company. You sell when you think the price is going down. But the insider selling extends far beyond household names. It's systematic, it's pervasive, and it's accelerating. In 2024 and early 2025, CEOs and executives across corporate America sold shares at levels not seen since 2007, across all industries: technology, finance, healthcare, consumer goods. The mortgage industry is particularly telling. In 2006, the year before the housing collapse, CEOs from the top 12 mortgage lenders sold $487 million worth of their own company stock, not exercising options and holding, selling, converting to cash. They saw the data. They knew what was coming. They got out while the public was still buying. Today, the same pattern is repeating. Insiders across the financial sector are liquidating positions at rates that match or exceed 2006 levels. They're reading the same loan performance data you could access if you knew where to look. They see the delinquencies rising. They see the defaults beginning. And they're selling. This is what I call the 3-trade playbook. It's a sequence that has protected and enriched smart investors in every crash for the past 100 years. And it's being executed right now. Trade 1. Convert to cash. This happens 12 to 18 months before the crash. The smart money doesn't wait for the peak. They don't try to time the exact top. They sell early, accept that they might leave some gains on the table, and move to safety. Joseph Kennedy did this in the summer of 1929. He liquidated his stock positions while the market was still rising, while his friends were still making money, while everyone told him he was crazy to sell. 3 months later, those friends were wiped out. Kennedy's cash was intact. Paul Tudor Jones did this in 1987. He raised cash through the spring and summer while the market climbed to new highs. His investors questioned his judgment. Then came Black Monday, the largest single-day percentage drop in history. Jones was already safe on the sidelines. John Paulson did this in 2006 and 2007. He moved his fund's assets to cash and defensive positions while the housing market still looked invincible. His investors demanded to know why he wasn't participating in the gains. Then the crash came, and those same investors thanked him for his caution. Trade 1 is happening now. The billionaires are out. The insiders are out. The people who see the real numbers are converting to cash. Trade 2. Accumulate gold. This happens during the same 12 to 24 month window. While you're sitting in cash, you need protection against currency debasement. Because when the crash comes, the government will print money. It always prints money, and printing money destroys purchasing power. Gold is the 5,000-year solution. It cannot be printed. It cannot be debased. It holds value when paper currencies fail. Bernard Baruch converted substantial positions to physical gold in 1929. When Roosevelt devalued the dollar in 1934, revaluing gold from 20 to 35 per ounce, Baruch's gold holdings gained 69% in dollar terms, while stocks continued falling. In 2008, gold was around $600 per ounce when the crisis began. Today, central banks around the world are accumulating gold at the fastest pace in decades. China, Russia, India, Poland, Singapore. They're not buying because gold is trendy. They're buying because they see what's coming. Gold prices have already begun their climb. But the real move, the parabolic surge that happens when confidence collapses, is still ahead. Trade 3. Position for the crash. This is the profit trade. Trade 1 protects you. Trade 2 preserves wealth. Trade 3 makes you rich. This trade requires instruments that pay off when markets collapse. In 1929, it was short selling, borrowing shares, selling them, and buying them back cheaper after the crash. Kennedy established short positions in the summer of 1929. When October came, he covered his shorts at collapsed prices and made an estimated $15 to $50 million. In today's dollars, that's hundreds of millions. In 1987, Paul Tudor Jones bought massive positions in put options on stock index futures. He spent millions in premiums, bleeding money while the market climbed. Then came Black Monday. His puts exploded in value. He made $100 million in a single day. His fund returned 62% for the month of October, while everyone else lost 20%. In 2008, Michael Burry and John Paulson bought credit default swaps on mortgage bonds. They paid premiums for years while the housing market stayed inflated. When the collapse came, their swaps paid off at ratios of 10 to 1, 20 to 1, even higher. Paulson's fund made $15 billion. Burry's fund returned over 400%. The mechanism changes, the pattern doesn't. Patient positioning before the crash. Massive profits when it arrives. Here's what I need you to understand. The billionaires are not selling because they need money. They're not selling because of tax planning. They're not selling because they've lost faith in their companies. They're selling because they see what's coming. They have access to data you don't see. They have analysts who study credit markets, derivative exposures, bank balance sheets. They know the system is fragile. They know the bubbles are unsustainable. And they know that when it breaks, it will break fast. This is not conspiracy theory. This is observable behavior. The data is public. The SEC filings are available. Anyone can see what the insiders are doing. The question is whether you're paying attention. In 1929, the public kept buying while Kennedy sold. In 2008, the public kept buying while Paulson positioned for the crash. In both cases, the public lost everything while the smart money preserved and multiplied their wealth. The same divergence is happening now. The same playbook is being executed. The billionaires are on one side of the trade. The question is, which side are you on? Because when the trigger comes, and it always comes, there will be no time to reposition. The exit doors will be jammed with people trying to get out simultaneously. The only ones who make it through are the ones who left early. The smart money is already gone. The clock is ticking. Every collapse needs a trigger. A single event that transforms years of accumulating fragility into sudden, violent unraveling. A moment when confidence breaks and panic begins. But here's what you need to understand about triggers. And this is the most important lesson from 1929 and 2008. The trigger is never the cause. The trigger is never what experts are watching. The trigger is always something dismissed as contained or too small to matter. Until overnight, it's the only thing that matters. In 1929, the trigger was margin calls. For years, economists and bankers had dismissed concerns about margin lending. Yes, people were borrowing to buy stocks. Yes, leverage was high, but the economy was strong. Corporations were profitable. The market had always recovered from dips. Margin debt wasn't a risk. It was a sign of confidence, a sign of American prosperity. Then the first wave of selling began. Prices dropped 5%. Suddenly, investors who had borrowed 90% of their stock's value faced a simple equation. Put up more cash or get liquidated. Most didn't have the cash. They were forced to sell. That selling pushed prices lower, which triggered more margin calls, which forced more selling. The trigger wasn't a corporate bankruptcy or an economic crisis. It was just mathematics. The cold logic of leverage working in reverse. Something that had been dismissed as a technicality became an extinction event. In 2008, the trigger was subprime mortgages. Subprime loans represented roughly 14% of the total mortgage market, a small slice. When defaults started rising in 2007, Fed Chairman Ben Bernanke assured Congress that the problem was contained. Contained. that word will live in infamy. What Bernanke didn't understand, what almost no one in power understood, was that subprime mortgages had been packaged, tranched, and distributed throughout the entire global financial system. They were hidden inside CDOs that pension funds owned. They were referenced by credit default swaps that banks had written. They were sitting on balance sheets from New York to Frankfurt to Tokyo. The subprime market was small, but it was connected to everything. When defaults reached a critical threshold, the CDOs failed. When the CDOs failed, banks took losses. When banks took losses, they stopped lending to each other. When interbank lending froze, the entire financial system seized up. The trigger wasn't the size of subprime, it was the interconnection. A small piece of the system failing revealed that the entire system was rotten. Now let me show you what could trigger the 2026 collapse. Not predictions, probabilities, not certainties, possibilities, because the trigger, by definition, will surprise everyone. Commercial real estate. Right now, approximately $1.5 trillion in commercial real estate loans are maturing between 2024 and 2026. These are loans on office buildings, shopping malls, hotels, properties whose values have collapsed since COVID. Here's the problem. These loans were written when interest rates were near zero. Now rates are above 4%. The buildings were valued when offices were full. Now vacancy rates in major cities exceed 20%. Some markets are worse. San Francisco office vacancy is above 35%. When these loans mature, building owners face a choice. Refinance at much higher rates on properties worth much less than the loan balance. Or default. Many will default, and those defaults will hit regional banks. The same regional banks that nearly collapsed in 2023 when Silicon Valley Bank failed. The same regional banks that hold the deposits of small businesses and communities across America. One major regional bank failure could trigger a cascade. Depositors would flee to safety. Other regional banks would face runs. The FDIC's $125 billion insurance fund would be exhausted in days. This is not speculation. The loans exist, the maturities are scheduled, the math is inescapable. The Japanese yen carry trade. For decades, investors have borrowed money in Japan, where interest rates were zero or negative, and invested it in higher yielding assets around the world. This is called the carry trade, and it has pumped trillions of dollars into global markets. In 2024, the Bank of Japan finally began raising interest rates. The yen, which had weakened for years, started strengthening. When the yen strengthens, carry trades unwind. Investors who borrowed in yen must buy yen to repay their loans. That buying strengthens the yen further, which forces more unwinding, which strengthens the yen more. In August 2024, we saw a preview. The yen strengthened sharply. Global markets dropped 3% in a single day. The Nikkei had its worst day since 1987. The VIX, the volatility index, spiked to levels not seen since the COVID crash. Then it stabilized. But the trade is still there. Trillions in yen-funded positions are still waiting to unwind. The next spike in the yen could trigger forced liquidation across global markets simultaneously. The derivatives time bomb. The global derivatives market now exceeds 600 trillion in notional value. That's not a typo. 600 trillion, roughly 10 times global GDP. Most of these derivatives are interest rate swaps, contracts that transfer interest rate risk between parties. They work fine when markets are stable, when rates move gradually, when everyone can meet their obligations. But derivatives are zero-sum. For every winner, there's a loser. And when rates move sharply, or when a major counterparty fails, the losses cascade through the system. AIG wrote credit default swaps worth hundreds of billions in 2008. When the underlying bonds defaulted, AIG couldn't pay. The government had to bail them out with 180 billion to prevent the collapse from spreading. Today, the derivatives market is many times larger. The counterparty risk is more concentrated. The 5 largest banks hold the majority of derivatives exposure. If one of them fails, or even if one of them appears to be failing, the entire global financial system could freeze. Sovereign debt crisis. Japan's government debt exceeds 260% of GDP, the highest in the developed world. Italy's exceeds 140%. France is above 110%. Even Germany, the poster child for fiscal responsibility, has seen debt climb dramatically. The United States is now at 120% and rising by $1 trillion every 100 days. What happens when bond investors decide that a major sovereign borrower can't repay? Interest rates spike, the government must pay more to borrow. Higher interest costs increase the deficit. The larger deficit requires more borrowing. It's a doom loop with no exit. Greece experienced this in 2012. The European Union bailed them out. But who bails out the United States? Who bails out Japan? There is no institution large enough. There is no lender of last resort for the lenders of last resort. Here's what I need you to understand about the trigger. I don't know what it will be. Nobody knows. The experts who claim to know are lying or deluded, but I know it will come from somewhere unexpected. Somewhere that seems small. Somewhere that authorities dismiss as contained. Think of it like a game of Jenga. The tower is wobbling. Every piece you remove makes it more unstable, but you can't predict which specific piece will cause the collapse. You only know that eventually one of them will. The commercial real estate crisis might be the piece. The yen-carry trade might be the piece. A derivative blow-up, a sovereign debt crisis, a geopolitical shock. Any of them could be the piece. Or it might be something else entirely. Something not on anyone's radar. Something that seems irrelevant today and obvious in hindsight. The pattern is clear. The triggers of 1929 and 2008 were dismissed until they detonated. The trigger of 2026 will follow the same script. And when it comes, when confidence breaks and the cascade begins, time will compress violently. What took years to build will unwind in weeks. The exit doors will jam. The lifeboats will fill. The only preparation that matters is the preparation you do before. Let me show you what comes after. Not predictions. History. Because we've seen this before. We know what happens when bubbles burst, when systems fail, when the mathematics of debt finally overwhelm the psychology of denial. And what's coming is worse than 1929, worse than 2008. Because this time, all three bubbles burst together. And the tools that saved us before no longer exist. In 1929, when the market crashed, only 10% of Americans owned stocks. The devastation was concentrated. Terrible for those affected, but limited in scope. The government had room to respond. Federal debt was 16% of GDP. There was capacity to borrow, to spend, to stimulate. And eventually, then after a decade of suffering, that capacity was used. The New Deal put people back to work. World War II completed the recovery. In 2008, the crash was broader. Housing wealth evaporated. Credit markets froze. But the government still had ammunition. The Federal Reserve's balance sheet was under $1 trillion. They expanded it to $4.5 trillion, buying toxic assets, injecting liquidity, backstopping failing institutions. Interest rates were above 5%. They cut them to zero and held them there for 7 years. The government could borrow because the national debt was manageable. They borrowed $700 billion for TOP. Trillions more for stimulus. It worked, barely. The system survived. But in 2026, the ammunition is gone. The Federal Reserve's balance sheet is already bloated at $7 trillion. Interest rates are already elevated. There's no room for dramatic cuts that would shock the economy back to life. The national debt exceeds $36 trillion, with interest payments consuming more than $1 trillion annually. When the crash comes, what can the government do? If they cut spending to stabilize the debt, they deepen the recession. If they borrow to stimulate, they risk a sovereign debt crisis. If they print money to monetize the debt, they ignite inflation that destroys what remains of the middle class. There are no good options. Every door leads to a different kind of pain. Let me tell you what the aftermath looks like for ordinary Americans. Your retirement account, the 401k you've been contributing to for 20 years, loses 40% to 60% of its value. This isn't speculation. It's what happened in 2008. It's what happened in 2000. It's what happens when bubbles burst. But this time, the recovery takes longer. Much longer. Japan's stock market crashed in 1990. The Nikkei fell from 39,000 to below 15,000. It did not recover to its 1989 high until 2024, 34 years. An entire generation of Japanese investors never recovered their wealth. They retired poorer than they expected. They watched their children struggle in an economy that never truly healed. If America follows Japan's path, and there are reasons to believe it could be worse, recovery might take decades. The retirement you planned for at 65 might not be possible until 85, if it's possible at all. Housing wealth destruction will trap millions of families. You can't sell a house for less than you owe on the mortgage. When prices fall 30% or 40%, as they did in the hardest hit markets in 2008, homeowners become prisoners in properties they can't afford to keep and can't afford to leave. The job market will be brutal, not just for a year or two, for a generation. Studies of people who graduated into the 2008 recession showed they earned less over their entire careers compared to people who graduated just a few years earlier. The economic scarring lasted decades. The careers that should have been never materialized. The promotions that should have come never arrived. The 2026 crash will be worse. College graduates in 2027 and 2028 will enter a job market where hundreds of applicants compete for every position. They'll start their careers 5 to 10 years behind where they should be. That delay will compound over a lifetime. Small businesses will be decimated. The local restaurant, the family-owned shop, the small manufacturer that employs 50 people in your town. These businesses survive on thin margins and fragile credit lines. When consumer spending collapses, when banks stop lending, they will fail by the hundreds of thousands. What emerges from the wreckage will be an economy even more dominated by massive corporations. Amazon, Walmart, the giants with access to capital markets and armies of lawyers. They'll survive those smaller. They'll buy the assets of failed competitors at pennies on the dollar. The economy that recovers, if it recovers, will be less dynamic, less competitive, less innovative. The small business formation that drives American prosperity will be suppressed for years, perhaps decades. Social safety nets will buckle under impossible strain. Unemployment benefits, food assistance, Medicaid, these programs are designed for normal recessions, not systemic collapse. When unemployment surges to 15% or 20%, when tax revenues collapse because nobody's earning money, the government will face an impossible choice. Cut benefits when people need them most, or borrow money that doesn't exist to fund programs that can't be sustained. The most vulnerable populations, the elderly on fixed incomes, the disabled, the working poor, will suffer most. They always do. The safety net that was supposed to catch them will have holes large enough to fall through. And then comes the political instability. Economic catastrophe doesn't just destroy wealth, it destroys social cohesion. It destroys faith in institutions. It creates fertile ground for extremism. The 1930s taught us this lesson. The Great Depression didn't just cause unemployment lines, it caused the rise of fascism in Europe. Weimar Germany's economic chaos, the hyperinflation, the mass unemployment, the humiliation created the conditions that brought Hitler to power. Americans like to believe they're immune, that our institutions are stronger, that it can't happen here. But when people lose everything, when their retirement vanishes, their home is foreclosed, their children can't find work, they look for someone to blame. And they listen to anyone who promises radical solutions. The political system that emerges from the 2026 crash will not be the one that went in. What it will look like, I cannot say. But history suggests it will be uglier, angrier, more divided than anything we've seen in our lifetimes. This is why 2026 is not just another recession, not just another market correction, not just another cycle. This is the convergence of three bubbles that have been inflating for decades. This is the exhaustion of every tool that saved us before. This is the moment when the bill comes due for 50 years of borrowed prosperity. In 1929, we learned that leverage kills. In 2008, we learned that interconnection spreads contagion. In 2026, we will learn both lessons again, simultaneously, with no cavalry coming over the hill. The pattern has played out before. Spain, Britain, the Soviet Union. Every empire believed it was different. Every empire was wrong. The mathematics doesn't care about American exceptionalism. The mathematics doesn't care about optimism or denial. The mathematics simply executes. The billionaires see it. That's why they're selling. The insiders see it. That's why they're converting to cash. The question is whether you see it. Because when the trigger comes, and it will come, there will be no time to prepare. The preparation that matters is the preparation you do now, before the crash, before the panic, before the exit doors jam. History has given you the pattern. History has given you the warning. What you do with that warning is up to you.